Welcome to Gold Silver Pros.
Hey everyone, this is Robert Kientz with 𝙂𝙊𝙇𝙀𝙍, and I'm here with a very special first-time guest on the program. I am joined by 𝙂𝙊𝙇, who runs 𝙂𝙊𝙇's Gold and Silver Digest, and you can find that at 𝙂𝙊𝙇𝙀𝙍.com, and steer is spelled S-T-E-E-R. Ed has been following this for over 25 years, has a lot of experience, has written many, many columns, and now has his own membership service. Ed, how are you doing today?
I'm great, Robert, and I hope you and your audience are doing well as well.
We are, and I think, Ed, a lot is going on in the world, and therefore that usually means when a lot's going on in the world, a lot's going on in the precious metals, because sometimes they reflect the general level of discontentedness, I'll call it, in the market. And a lot, with all of that going on, people are asking me questions about gold and silver. Of course, we run an educational service to try to educate people, and I thought, this topic is so complex. I really want to reach out to someone who's been doing a lot longer. And I had read your, especially when I first started learning gold and silver about 13 years ago, I spent a lot of time on your columns. You before the call had mentioned Ted Butler. I'd read a lot of his stuff. David Morgan, who's a good friend of mine, read a lot of his, Alasdair Macleod, a lot of people in the market. And I just have a lot of respect for you guys who've been doing this for a long time. And that's why I wanted to have you on. So thank you for joining. First question I have for you is, it seems as though in one of the columns I just wrote that's out now was on the inventories. It seems as though in COMEX, whatever we had in silver dating back a year and a half ago, we don't have that much silver left on the COMEX or gold, but silver to a bigger degree. It seems as though some of the inventories on the major exchanges are being, taken off in some cases, or put into the eligible category where they're not for immediate trade. Is there anything going on with worldwide gold and silver inventories that interests you, or that seems interesting now? Or are we in any sort of shortage situation? Do you think there's plenty left out there, or is it difficult to determine based upon the data that we have?
Well, it's crystal clear from the data that we have, everybody's talking about it. And as you mentioned, Ted has been on this for a lot longer than you, me, or everybody else. Mm-hmm. But the COMEX inventories are being drained, not only physically being shipped out the door, but we're also seeing, as you mentioned, a shift from the registered category and back into eligible, which means basically that it's being moved into long-term storage where the people who own it have no interest in selling it at this time. So the drain is not only physically out of the COMEX, but it's also, like I said, going from registered to eligible. We're seeing that in withdrawals from SLV and conversion of shares. We're seeing that the LBMA, the retail bullion market is on fire. The wholesale good delivery bar market is the demand is just absolutely astronomical, no matter where you care to look. And of course, that obviously showing up in depleted inventories. And all we need now is a price to match that fact, which we don't have.
That's been the subject that I've probably talked about on our program more than any other over the last few years, is the fact that you have this derivative market in which people will come and bet on essentially they're betting on the spot price of silver, and they're taking a position either with a future, an option, or gold into some point in the future, usually 3 to 5 months. You can go longer on the futures if you want, but usually it's, there's 6 delivery months a year, big ones, and they'll work those delivery months. So we have that action, which determines the spot price. And if you want to add in what goes on in London OTC as well. And then there's what's going on physically with either the very few contracts that settle physically on COMEX, or the retail market, or the fact that now some companies are coming out and buying directly from mines. There is a disconnect between the physical and the paper market. And Ed, why does that exist? Why do we have such a big disconnect on what the spot price is and what the physical trade is actually telling us about gold and silver?
Well, as you mentioned, the price of all major commodities is set in the COMEX futures market. And, as Ted has pointed out many times in the past, the COMEX, the NYMEX and the CME group are basically criminal organizations that allow these price management schemes to continue, not just in silver and gold, but the other precious metals and a few other commodities as well. You know, Ted says it's been going on for at least 40 years in the COMEX futures market. I'd say it's more like 50, but I know what's 10 years between friends, you know. But the fact of the matter is that 4 or 5 or a handful of traders, the largest 8 traders, Ted says, you know, they've been controlling which are all major bullion banks or investment houses, have been controlling the price of precious metals and other commodities now for several generations. And they set the price, and it doesn't make any difference what supply and demand is at all. It only matters what's being traded in the COMEX futures market, and that alone determines the price, which is criminal, because that's not the way it's supposed to be at all. But if you're looking for a reason why the price of gold, silver, platinum, palladium, and copper and crude oil and probably other commodities are where they are right now today, it's because it's being set by a handful of traders doing it illegally in the COMEX futures market.
Yeah, and two pieces of information to help us understand the big players. So if you look at the CFTC Commitment of Traders report, it'll give you a clue that the bullion banks are the ones that hold the big shorts. And if you dive down that information, you know that or if you look at Nick Laird's site, Gold Charts R Us, you'll know that there are 4 and 8 big banks which control that. I also found this year the Office of the Comptroller of the Currency report on derivatives breaks down who the 4 big banks are in gold and silver, and it's Bank of America, Citigroup, Goldman Sachs, and JP Morgan, according to the OCC. So those guys, not only are they some of the biggest participants and basically the market makers in the U.S. gold and silver market, but they're big players in all the derivative markets. When you see something like that, Ed, has it ever occurred to you why 4 banks would want to have so much control organizationally over all these derivative markets? Is it just to profit from trade, or there are other things there? I mean, what have you found over the years? Why this concentration in just these big banks?
Well, there certainly is a profit motive in there. However, my opinion is that they're in there to basically keep everything paper propped up and keep everything physical suppressed, so people don't go running from the paper asset side of the street to the physical asset side of the street, which is what they're showing signs of doing now. But this has been their policy now for 40 or 50 years, and it goes back probably even further than that, to when we went off the gold exchange standard in 1971. And as far as these bullion banks are concerned, there's like 5 or 6 or 7, like you said, plus a couple of investment houses. And as you mentioned the fact market makers, and as Ted correctly pointed out, who died and appointed them as market makers in all these commodities? They're controlling them for a specific reason, and that's the price. And like I said, it's criminal from one end to the other. But as Ted has been commenting on since the LME nickel thing blew up in London on March the 8th, the big shorts in the COMEX futures market in the precious metals have been moving heaven and earth to get out of their short positions, and that's been going on right up until last Friday. And right now they're the least short they've ever been. So hopefully this thing is going to come to an end sooner rather than later, but we're all still waiting for that day.
Do you think that's a bullish sign that they flipped? The bullion banks went net long silver specifically, and I also would say that they're reducing their short position of gold. I think when I looked at the latest COT report a couple of days ago, they were only 50,000 gold contracts to the long side. They used to be like 80,000, not like a couple of months ago.
They've really made a concentrated effort in the last 3 or 4 weeks to get out of their short positions in gold. Yeah. They've been doing it in silver since March. This is something that I write about in my column that Ted comments on in his column, and it's his work that I follow on this. But the fact of the matter is that the bullion banks are not out of their short positions yet. They've reduced them by a gigantic amount, but they're still short a bit. So for them to get out of the short positions entirely would entail prices of silver and gold that I don't even want to talk about, and I don't even think that these bullion banks are contemplating getting out entirely, just want to reduce them as much as they can. So as of today, that's where we stand. It's looking very good in the COMEX futures market right now. And we're just waiting for the day when they decide to back off and not reshort the market when the next rally begins.
Yeah, I have a question for you on positioning. So the bullion banks are net short on something. How badly can that hit them? Let's say they're net short on silver. I'm just going to throw a number: 10,000 contracts net. And so the price of silver goes up, $8 an ounce. How does that affect that? Does it affect their solvency? Is there do they get margin called on their positions? What happens if they're so far out of the money on one of these futures positions? How badly can it hit one of these banks?
Okay, well, this is one thing that they get margin calls probably more than once a day. Just like everybody else, they're not immune to this. Okay, but as Ted pointed out several months ago, he said their short position now in gold and silver and just about everything else, the bullion bank's short position in these things is now so small, they've probably been able to hedge it in the over-the-counter market or other markets beside that. So they may be out of pocket in one hand, but they're taking it from a trade that they got with somebody else somewhere else, and so their net they're zero, even though they show that short positions, and that's what Ted figures that these 8 traders have done, is they've got it so small now that they've laid off the risk in other markets.
Can you talk about that for a moment? Because this is something that really confuses people who don't have time to follow the market every day. There are multiple ways to invest in the metals. You mentioned, they could hedge it going somewhere else. They could hedge it going over the counter, which I'm assuming you mean the London market or what the LBMA manages. Couldn't they also do it through other derivatives? Like, could they do SLV and GLD? How many ways can they hedge themselves?
Oh, without doubt, I'm sure that large portions of SLV and GLD are owned by these 8 large traders. Mm-hmm. And, GLD, SLV, and all the other mutual funds and ETFs out there, if you take a look at the charts of how much gold and silver are in them, and I post them on my column every Saturday, I would say a large percentage of the precious metals being held, they're held by the strongest of hands. And that would probably include some of the bullion banks and their friends and relatives sort of thing. So, my opinion is that when this thing does finally go, the traders that matter, like the big 4 or big 5 or 6, the too big to fail banks, probably pretty much covered. And if the other traders in the big 8 or 10 or 12 or the big 20 traders, if they haven't been able to cover in other markets, then they're going to burn, and they're just going to add to the price explosion when it finally does arrive.
Okay, interesting. About the SLV specifically, I think you had some comments on another show recently, and I just kind of wanted to explore that a little bit. The SLV, in my understanding, is a derivative product set up to absorb, typically through like passive investing, an ETF fund, essentially. So people invest in silver, but they don't actually invest in silver. It's not like you're getting a share of a mining stock, and you're certainly not getting the physical. And I've been through the prospectus several times. Last week, I went through it twice, as I plan on doing a show on this going forward. What the prospectus says is, if you're one of the authorized participants, which essentially are bullion banks for all intents.
That's what they are, yes.
Yeah, and JP Morgan
That's what they are, the bullion banks, yeah.
Yeah, so authorized participant can redeem a basket of 50,000 shares and get the metal. If you're a regular shareholder, it ain't happening. So what I see happening when I look at SLV's inventories, they've been falling pretty precipitously. The metal's being taken out of the fund. There is also a large short position on them. I think it's like 59 million shares now. It was 61 million at one point, or almost 61 million. So that you got share shorting going on, which keeps SLV's price down. Then you got authorized participants taking the metal off, so somebody's giving up their shares. Do you have any insight as to what's going on there? Do you think, I thought maybe this is some sort of rate on the SLV silver, but they have to follow a process. So what am I missing there? Why, when I know physical demand in the retail market's really strong, are people going to SLV to get that physical because they need it, because there's not enough on the market? Or is there another thing going on here that you think when you look at that?
No, I think you said it well just now. if you need silver, the go-to place to get it is SLV. You just go in and buy the number of shares, ounces that you need, and redeem it for metal right away. And that's one of the reasons why you're seeing the SLV drop as precipitously. You know, just you got to use the COMEX and SLV interchangeably. They're both stores of physical metal. And I don't doubt for a second, you know, lots of people don't believe that the metal is there. It's SLV. I certainly do. All you have to do is look at the bar list. But, you know, it's like LBMA and the COMEX and everywhere else, or any physical, you know, retail store. I mean, everybody's just selling the metal hand over fist, and it's just getting very hard to come by. And if you want it in size, SLV is about the only place you're going to be able to get it. And some people are just taking their shares and say, you know, I want the physical, and they just hand in their shares and take physical delivery of the metal, and it just sits there, but it's off the exchange at the moment. And as far as, you know, the short position in SLV, which you correctly say is around 59 million troy ounces as of about a week ago, and we get the next short report next week. You know, that's just further proof. You know, Ted's the real authority on this, and he follows it religiously. You know, all it is further proof that there's just no physical silver available in size, because if you short the shares, you're required under the prospectus to deposit this, you know, the physical metal to go along with that. And obviously, it's not available to who's ever shorting the shares, and so it shows up as a short position in SLV. It's criminal. Ted has been bugging BlackRock about it for a very long time now, and it's still way up there in nosebleed territory, record territory. And it just if you need another brick in the wall for why you know, for the obvious physical shortage in silver, the short position in SLV is it.
I think from reading the prospectus, and I'm just spitballing, and if you don't know the answer, it's okay. But from reading the prospectus, the shares of SLV are a bit different than, say, shares of Tesla. Because when let's say you buy a share of Tesla, you can't turn in a certain amount of shares and get a Tesla, right?
No.
So the SLV is set up differently. It's the creation and destruction of shares are all around the demand for physical. So why would there even be allowed to be a short position on that stock? Like, who's shorting that stock, and how could they do it? You mentioned, Ted said it may be criminal activity, but like, why would you want to short SLV? I don't quite get why anybody want to do that, because I mean, yeah, if you think SLV has downside price because silver has downside price, I could kind of get it, but aren't there better ways to do it? Wouldn't it be better to go take a futures position? Why do so many shorts exist on SLV in the first place?
Well, they're trying to control the price now. As you pointed out, I don't really know 100% the answer to that, but, you know, I want to just segue over to, say, PSLV, you know, the Sprott one.
Yes.
I think that's PSLV. You know, they have a minimum share requirement. If you want to redeem from them, you have to, I think it's 5 COMEX contracts. So you have to redeem 25,000 ounces before you can get physical, 25,000 shares or whatever before you get physical delivery.
Yeah.
Most ETFs have that ability where you can redeem if you wish to do so. No, it hasn't happened in PSLV. You know, they're now the third largest ETF, silver ETF out there. But of course, they're nowhere near what SLV is. But you know, most ETFs have, you know, you can withdraw silver if you forward the average, the number of shares that's required. Now, these are the big players, obviously. And for people like you and I and most of our listeners out there, the fact of the matter is, if you want physical metal, just go down to the store and buy it, or buy it online. I mean, that's what we've all been doing. I've been doing it for the last 25 years now. And, you know, so I don't feel outed or hurt or personally insulted that I can't redeem my shares in PSLV or in SLV or any of these other ETFs, because that's where the big boys are. And so if I want my own personal stash, man, I just walk down to the Bullion store or order it online. It's not a big deal. The only real unfortunate thing, of course, is that when you're buying good delivery bars, by the pallet load, you get them for a lot cheaper than you can pick up a 100-ounce bar or a kilo bar from any of the retail stores around the world these days. That's the only real big difference.
Yeah. I wanted to add in a piece of research one of my followers had done. 𝙈𝙂𝙇𝙿 is a registered chartered financial analyst. He works in London. was a director of a company for a long time and has done a lot of financial statement analysis. And my background was I used to be an auditor. I was a technology auditor, but I did a lot of financial and business statement auditing for KPMG, Ernst & Young, Verizon, a lot of other big companies here in the United States. And so we, having both a CFA and auditor background, kind of have this ability to dig into stuff and kind of figure some stuff out. So what we had done last year was the Perth Mint, which is basically a government-owned entity in Australia, and so therefore have financial reporting requirements, puts out every year their financials. And Daniel, got a tip to go look at them. Somebody said, just go look at them. So he did his financial statement analysis. I won't bore people with the details, but his analysis, which he put on a spreadsheet, and we covered over 5 videos on our channel in detail, showed that Perth Mint was about 920 or 930 million Australian dollars, had a receivable for that amount. And what we figured out we think they had done was taken customer money, bought the metal, but lent it out to a major counterparty. Now, this story was picked up by 𝙃𝙀𝙍, and the CEO at the time went on 𝙃𝙀𝙍 and was defending that, saying, well, we actually have it, it's work in progress. And work in progress is metal that comes in and hadn't been refined. And I'm like, there's not $1 billion of metal in your work in progress. That's ridiculous. And so we think what they were doing was they had lent out, and they had, in fact, created a receivable on their balance sheet for this metal, meaning somebody else owned it. And they were receiving money for having lent it out. So basically like a lease rate, if you will. Anyway, long story short, they start to unwind this position. And as of last year's financial statement says 300 million. And then as part of this, they had an ETF, and they sold the ETF to Goldman Sachs. And what I'm getting to is, you were talking about ETFs and redeeming. When Goldman Sachs got this ETF from Perth Mint and bought it, they immediately, according to the news story I saw in the press, removed redemption for physical precious metals. Now, I don't know if they've reinstated that, but as soon as Goldman Sachs got this ETF from the Perth Mint, who we knew had lent out the metal, some of which we believe was flowing to the ETF, Goldman Sachs said, you can't redeem shares for metal. So I'm wondering, Ed, if this contagion seems to, of lack of available metal, has stretched out to some of the big places like Perth Mint. And I think that's just another sign that we're really short metal, that they're trying to make it appear as though we have more metal than not. And I know you haven't watched those video series, but it seems to be another sort of nail in the coffin of the argument that there's a lot of gold and silver available. I didn't know if you were aware of that at all, or had any comment on and done anything on any of the bullion or the mints, and seen what had been going on there.
Well, Robert, I'll tell you the truth. I did watch some of those videos, and I am aware of it. I have a general ballpark idea of what you guys were talking about.
Yeah.
And we're talking exclusively about silver here, but the shortage in gold, I would suggest, by what we're seeing out there, is that we're starting to see signs of that as well. So let's not forget gold. But the big story about Perth Mint and 𝙃𝙀𝙍, since you both brought them both up, is something that Ted Butler's been on for more than 20 years ago. He wrote articles about this, and about 17 years ago he wrote another one recently last year, about these sales of phantom silver. You can buy these what are they? I can't remember what they call them, but you can buy these. You buy the silver, but you don't actually own the stuff. Okay, and nobody knows for sure how much of this phantom silver that 𝙃𝙀𝙍 or Perth Mint have sold. And but there's lots of it out there where you can buy it at spot. It's unallocated, and Ted figures that's the biggest scam out there with the Perth Mint. And of course, you mentioned this other thing with your friend that did the auditing. I'm not discounting that. I just don't know enough about it to make a comment on it.
Yeah.
But there's lots of other smoke flying around the Perth Mint right now, and I'm pretty sure that if once they do some digging, they're going to find a lot of stuff in there they're not going to really like.
Would it be, and just asking your opinion on this, would it be safe to say that if we were looking at the gold and silver market from start to finish, when we pull it out of the ground to the point at which it goes to a retail or industrial sale to someone, would it surprise you if at every step along that way there had been a bunch of double counting or rehypothecation or covering up of actual physical supplies. I mean, if it came out there's a big scandal on gold and silver across every step of the supply chain, would that surprise you at all?
Well, I'll tell you what. You're talking of a whole thing that I know I know something about.
Yeah.
The mines produce either the ore or the doré bar, which goes to the refiner, and they refine it into the metal. Now, I doubt very much, but I don't know for sure, so don't quote me. So nobody take me as this is gospel. I doubt very much there's much hanky-panky going on up until the time it's actually refined into the physical product itself. Once it gets to that point, then, well, all bets are off. But, the physical market is totally different than the paper market, and I think that's a differentiation that has to be made. The fact of the matter is that, as we started at the top of this show, the physical silver market is in a huge deficit. The demand is way, way more than supply. And when we start to see problems in the silver market, it's going to show up in the paper market where, the thing is going to finally blow sky high. So one of these days, the physical market will trump paper. And as you and I and everybody else in the world, that's the day that we're waiting for.
We've been waiting a long time, Ed. I've only been doing this for 13 years. It's not near as much as you or Ted Butler or a lot of these, other people. I'm guessing a little bit younger generation than you guys. But trying to pick up the torch a little bit and tell the story. Has it surprised you how long this story's been going on before it seems as though we're getting to like a squeeze condition or a shortage condition in silver? Did it go on longer than you thought it would? And do you think it's still got some ways to run before we see whatever the resolution is going to be?
Yeah, well, as Ted has pointed out several times over the last couple of years, this thing has carried on far, far longer than even he expected that it would, because he's been at this, and like you said, for, very close to 40 years. And for a price management scheme to go on that long, it has to have some official cover behind it. And as to whether it's going to come to an end or not, it appears that from the COT data that the big commercial shorts that have been sitting on the prices of precious metals for several generations now are clearing the decks for higher prices. And Ted's been following this since forever. And it really started to come to fruition at the moment that the LME nickel market broke. And from that point on, the price has been going down, 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 down. And that's because in order for these big commercial banks to get out of the short positions, they have to rig prices lower to get the managed money traders to go short against them. And that's why we've been going through all this price pain from that time and up until last Friday. So the fact of the matter is that it looks like the banks, the critical banks, are clearing the decks for a big move higher. And like I just said, we're all waiting for the day when we see that finally they've given up the ghost and don't short the next rally when it's allowed to begin. And it may have started already.
Yeah, I want to get your opinion on that too. So this past weekend, I know several dealers in the industry just haven't been involved with it for so long. I was looking at a wholesaler's bar list, and of course I can't publish it. It's private information, but they were out of 99% of silver. And this is a worldwide wholesaler, a big one that supplies a lot of the bullion companies here in the US. And they were out of most gold as well. And the premiums had started to spike. We got that information Saturday. And of course, when the market opened, we had a nice little bump Sunday night, but Monday morning, the market started climbing again. Do you suppose, is it a combination of them getting out of the short position or moving away from it and the physical shortage information coming to light that's causing people to bid the price up? Or what do you think is the cause for the recent move?
The recent move in price is basically the managed money traders covering short positions. This is all a paper move in the COMEX futures market.
Move. Yeah.
Okay. The thing is that the supply-demand fundamentals have not been allowed to kick in. We haven't had a free market in the precious metals ever. Okay. Not in 20 years, 40 years, 50 years. The price of gold has always been set. It was at $20 an ounce. I think the U.S. government keeps on their books at $40 an ounce. Nobody knows what the true free market prices of gold and silver are because it has never been allowed to trade freely. That's the day that we're all waiting for. And physical demand out there, I'm not surprised that there's nothing for sale or very difficult to get anything. And retail demand is completely controlled by what the private and sovereign mints can produce. If the sovereign and private mints can produce X number of ounces of silver, well, that has the supply equals the demand, because you can't have any more demand than there is supply. And we've seen it several times over the last many years, where we've been up against the wall, where delivery times are 2, 3, 4 months down the road. And we're pretty much at that point now, where if you want something, it's getting to the stage where you're going to have to wait for it. Once again, we've been there before, and the next time we go there, when prices really sail, it'll be difficult to get silver at all, if we ever are allowed to get it again.
Yeah, one last question I wanted to ask you. You often in the past have talked about the dollar index in your columns, and specifically as it relates to precious metals. What in your understanding is the relationship between the DXY and the precious metals? Is there a correlation where they move in opposite directions, or how does the quote unquote strength of the dollar? I mean, we're not counting the inflation adjusted dollar. We're just looking at dollar against the basket of all the other currencies. But how does the DXY affect the gold and silver price? Does it matter at all?
Well, if there was a free market, there would be the as the dollar went up, precious metals would fall, and that would be the price of all commodities, not just the precious metals. Okay, but the fact of the matter is that this dollar rally that we're seeing right now, quote unquote, is a run from every other currency into the dollar. The dollar is just what the cleanest dirty shirt in the laundry, as everybody says. But the fact of the matter is this. The bullion banks are using these rallies in the dollar to smack precious metal prices, because if they took their hands off of precious metal prices, even with a dollar index rally in progress, the precious metals would blow sky high anyway. So this rise in the dollar index and the fall in the precious metals is all a smokescreen behind which the big bullion banks and the large commercial traders are going about their business, okay? Because like I said, if the moment they stop shorting this market, these big 8 traders stop shorting the market, I don't care what the dollar index is doing, going up, down, sideways, you're going to see the price of precious metals and other commodities blow sky high. So is there a relationship? In a normal market, there would be. In this market, it's only because the bullion banks and the others are making it. So that's all. Okay. Any last thoughts, Ed, on this subject, the stuff I haven't asked you, perhaps, that you wanted to add in for the listeners? No, the only thing is, if I was giving investment advice, and I'm not, to anybody, if you haven't bought any silver, if you want to buy some more, the time, despite the fact it's up $1 or so or $2, whatever, from its low on Friday, there's a day is going to come when it's just not going to be available at all, or going to be lead times, and the price is going to be through the moon. So my recommendation, and I eat my own cooking on this, is to buy as much as you feel comfortable in affording to buy before the day comes when it's going to be priced to the moon. Okay. Ed, I wanted to thank you so much for coming on the program. I've been following your stuff for years and years and years. And when I first started reading about the precious metals in 2009, after the financial crisis, you were one of the spots that I went to on a daily basis. So you have done so much in helping educate me, and I appreciate you taking the time to join us on the call. Tell us a little bit about your service, your newsletter, and how people can get more information on that. Yeah, I write a daily blog on the precious metals and international finance. Just Google my name, Ed Steer, S-T-E-E-R, gold and silver, and my column will pop up. And you could go onto my website, and there's a tab there for a sample column, and you can read what's in that sample column. And if that sort of information about the precious metals interests you, you can sign up, and the freight is $100 US per year, which in Canada, which is where I live, right now, because of the exchange rate, is about $135 per year. Okay, perfect. Yeah, that's not much at all for the information that you provide. I know you spend all day working on your reports, and they're absolutely chock full of information. So if somebody wants a really good view on the mechanics and the daily trade of what's going on in gold and silver, definitely pay attention to Ed Steer's report. Again, it's something that I relied on extensively when I was first starting to understand how everything worked. Ed, thanks for joining the program. We appreciate it very much. And thanks for having me on. I appreciate it, Robert.
Absolutely.